Imagine you're about to make a crucial financial decision. You have two options, one with a 70% chance of success or another with a 30% chance of failure. Which would you choose? If you're like most people, the first option sounds far more appealing, even though they're mathematically identical. This, my friends, is the power of framing in finance. Welcome to the Economy Unpacked Daily YouTube channel. From Wall Street to your street, we share the world of money in a clear way. Today, we're diving deep into the fascinating world of the framing effect and how it shapes our financial decisions. Every day, we're bombarded with information that influences our choices, often without us even realizing it. The way financial information is presented can dramatically alter our perception and ultimately our actions. This is especially crucial when it comes to money, one of the most emotionally charged areas of our lives. So, what exactly is the framing effect? It's a cognitive bias where people react differently to the same information depending on how it is presented. In finance, this can mean the difference between making a sound investment and falling into a costly trap. Understanding this effect is crucial because it impacts everything from our personal savings to global market trends. The concept of framing isn't just some academic theory. It's rooted in groundbreaking research by psychologists Daniel Kahneman and Amos Tversky. They showed that humans don't always make rational decisions, especially when it comes to money. Instead, we often rely on mental shortcuts, and how choices are framed plays a huge role in our decision-making process. In finance, it's rarely just about the numbers. It's about how those numbers are communicated to us. Let's break this down with a practical example. Imagine a stock that's described as having a 70% chance of growth. Sounds pretty attractive, right? Now, what if the same stock was described as having a 30% chance of decline? Suddenly, it feels much riskier, even though the information is identical. This is where the concept of loss aversion comes into play. We tend to fear losses about twice as strongly as we value gains. It's why we might sell stocks too early during a market downturn or hesitate to invest despite solid fundamentals. But it's not just about how we interpret information, it's also about how that information reaches us in the first place. The media plays a massive role in shaping our financial perceptions. News outlets often frame stories to drive engagement, not necessarily to provide balanced information. A headline like "Markets gain 2% feels very different from "Markets avoid steep losses," even when they're reporting the same event. And it's not just the news. Advertisers in banking and insurance are masters of framing. They'll highlight protection instead of risk exposure. Politicians and policymakers use similar techniques to frame economic data in ways that support their agendas. This framing isn't just academic. It's a part of our everyday financial ecosystem. To really drive this point home, let's look at some real-life examples. During market volatility, stock prices often react more to how news is framed than to the actual content of the news. Credit card companies entice us with promotions that highlight earning rewards instead of spending more. Insurance companies frame premiums as peace of mind for your family rather than monthly costs. These framing techniques are used globally from the US to the UK, Canada to Australia, showing how universal these psychological triggers are in finance. The psychological impact of framing on individuals can't be overstated. During market downturns, negative framing in the news can amplify fear, causing investors to panic and make rash decisions. On the flip side, overly optimistic framing can create bubbles, as we've seen in crypto or tech hype cycles. Fear and optimism are powerful drivers, and framing acts as the trigger that magnifies these emotions. So, how can we protect ourselves from falling victim to framing bias? First, slow down. Don't react impulsively to financial news or opportunities. Take the time to seek out multiple sources to counter single-frame bias. Try to look past the wording and focus on the actual probability or data. Ask yourself reflective questions like, would I make the same decision if this information was presented differently? By doing this, you're empowering yourself to make more informed, rational financial decisions. As we look to the future of financial framing, it's clear that the landscape is changing rapidly. With the rise of social media and financial influencers, framing has become even more influential. Information spreads quickly and emotionally, making it crucial for us to be more discerning than ever. At the same time, there's increasing pressure for ethical financial communication from institutions and regulators. While the framing effect won't disappear, it will evolve, making financial literacy more important than ever. In conclusion, recognizing the power of framing in finance is crucial for making sound financial decisions. We must approach financial information with critical thinking and healthy skepticism. Remember, how information is presented can be just as important as the information itself. By being aware of framing effects, we can make more informed choices and take control of our financial futures. Now, I want to hear from you. Have you noticed framing effects in your own financial decisions? Share your experiences in the comments below. And if you found this information valuable, don't forget to subscribe to our channel for more insights into the world of finance. Together, we can navigate the complex world of money with clarity and confidence. Until next time, this is Economy Unpacked Daily, helping you see beyond the frame to the bigger financial picture.